Right, good morning everyone, and a very warm welcome to all of you to iFAST Mid-Year Review 2023. So my name is 𝗪𝘃 and I'm from the research team at iFAST. So this is actually the second year in a row that we're holding this event here at the 𝗪𝘆𝘀. And I can clearly remember that 1 year ago, I was up on this very stage to share the outlook for the second half of 2022. Now, if you look at the screen, you can see that the title of my presentation at the time was "Your Mortgage Rate is going to spike to 5%. So last year, my presentation, it was mainly centered around two main topics. The first is inflation, and the second is interest rates. So we laid out our reasons for why we think inflation is in a structural shift, and decades of low inflation, it is coming to an end. And earlier this year, during our Invest Expo 2023, we also reiterated our view that both inflation and interest rates are going to remain higher for longer, as central banks will likely have to keep rates high in order to bring inflation down. And if we fast forward to today, you can see that our view on these matters, they remain largely the same. So although headline inflation in the US has actually decreased, it is largely driven by a decline in energy prices. And if you look at core inflation, it still remains elevated. So as it stands right now, inflation, it is still far from the Fed's target of 2%. So persistently high inflation has also forced the Fed's hand as it raised rates by 500 basis points in a span of 15 months, as you can see from the table on the right. And this is actually one of the most aggressive rate hiking cycles that we have seen since 1980s. And while the Fed has opted to pause in June, it revised its terminal rate forecast up from 5.1% to 5.6% by the end of this year. So this also indicates that the Fed is actually planning for at least 1 or 2 more rate hikes before the year ends. So Fed Chair Jerome Powell has also repeatedly said that interest rates are going to stay higher for longer, as the current outlook on inflation is still not supportive of a rate cut yet. So with the outlook largely the same as before, we decided to do things a little bit differently for mid-year review this year. So instead of repeating the same few points on inflation, recession, and interest rates over and over again, what we will do this year is to focus more on ideas that could do well in a rebound or even in the longer term. So this is why if you look at our program today, the ideas, the topics, they are mainly centered around longer-term investment ideas. And to start things off, I'll be sharing about one sector which we think has the potential to do well in the decades to come. So if you've been keeping up with markets, you know that equity markets, they have performed quite well year to date, despite slowing economic growth. So one sector in particular has done exceptionally well, and that is none other than the tech sector, or the digital economy sector as we call it. So as of the end of June, tech stocks, they have risen by more than 40% year to date in SGD terms, following the risk-on market rally and also the euphoria surrounding AI, which has taken the market by storm. So this AI frenzy, it actually started in late 2022 when ChatGPT was first announced. And a couple of months ago, NVIDIA also shocked the world with its AI-fueled sales forecast, which was more than 50% higher compared to the median analyst estimates. So even companies outside of the tech industry, they are also trying to cash in on this AI gold rush by bringing up the term AI in their earnings call. So an analysis conducted by Bloomberg News, it shows that mentions of AI among S&P 500 companies during the recent earnings calls have more than doubled in the recent quarters. But whether or not these companies they actually are involved in AI, it is another question altogether. But the thing is, with so many companies claiming AI capabilities these days, it makes it really difficult for investors like you to invest in this team. You don't know what you're buying into. So instead of investing into AI funds directly, we propose an alternative method. So back in the 19th century, during the California gold rush, there's a saying which goes, during a gold rush, you want to be selling shovels. So this saying arose when it became clear that the people who actually made money from the gold rush were not the gold miners themselves, but actually the people who seized the opportunity to sell things like shovels, pots and pans, jeans, so on and so forth. And if we apply this analogy to AI, the equivalent of shovels in this case would be semiconductors, and the people who are producing semiconductors are your chip makers like NVIDIA, TSMC, AMD, so on and so forth. So if you still don't catch my drift, essentially what I'm trying to say is if you want to cash in on the AI rush, One good way to do so would be through semiconductor companies. So semiconductors, they are the foundation of all electronic products, including AI. So AI systems, they rely heavily on modern technology, and they actually rely heavily on hardware that can handle multiple tasks simultaneously, such as your image and speech recognition, data processing, and also making complex calculations and decisions all within a short span of time. So all these functions, they require massive amounts of computing power that only the most advanced chips in the world can deliver. And as these AI applications become increasingly complex, the need for advanced semiconductor chips will also rise as well. And as of today, you can see on the screen over here that the market size for AI chips, it currently stands at about $17 billion US, which is relatively small. However, estimates by various market research firms shows that the AI chip market will go through a period of exponential growth and reach close to $230 billion US by the year 2032. So this is also equivalent to a compound annual growth rate of about 30%. So naturally, the AI rush will be a tremendous opportunity for semiconductor companies over the next decade. And again, this is one of the biggest reasons why we think investors can cash in on the AI story through the semiconductor sector. Now, for the benefit of those who are not familiar with this industry, I'll just do a brief introduction. So first of all, I want to make it clear that AI is not the only application for semiconductors. Okay? There are numerous other applications like your smartphones, your PCs, even cars nowadays have plenty of semiconductors in them. And all these applications will continue to drive demand for semis. So essentially, the companies that operate in this sector, they can be classified into four main groups. So first of all, you have your fabless companies. So these are companies that only do the design and they outsource the manufacturing to foundries to actually create the chips for them. So foundries are the companies like TSMC who take in orders from fabless companies like AMD and NVIDIA, and then they produce the chips for them. So in the middle of these two companies, you have what we call the integrated device manufacturers. So these companies, they do both the design and manufacturing. And the advantage of this is that they have absolute control over every step of the manufacturing process, and they can ensure that the chips are made to their specific expectations. And last but not least, we have your equipment manufacturers. So equipment manufacturers are companies like ASML, who produce things like EUV machines, which are used in the chip making process. So together, all these companies, they produce products like your memory chips, processors, sensors, so on and so forth that goes into all our electronic products. Now, let's take a look at how these companies have been performing this year. So year to date, share prices, they have done pretty well, rising by about 50% on aggregate already. So earnings, however, have not been able to keep up with this surge in share prices, resulting in expensive valuations for the sector. So on a forward 12-month basis, chip makers, they are currently trading at around 30 times earnings, which is considerably higher compared to its long-term average levels. And one of the main reasons why earnings for semiconductor companies, they have not been able to keep up is because the semiconductor industry is currently in a down cycle. So if you take a look at this chart over here, it shows you the semiconductor sales growth over decades. And you can see that the sector actually had 11 quarters of positive sales growth since 2020 before it turned negative in the fourth quarter of last year. And earlier this year, in the first quarter of 2023, sales growth fell even further, coming in at negative 20%. Now, while there are a number of reasons that can explain why sales growth has been falling, most of these reasons can actually be traced back to imbalances between supply and demand. So as many people were stuck at home during the early days of the pandemic, trends like your remote working were starting to gain traction, resulting in heavy demand for consumer electronics. At the same time, many businesses, they also made use of this opportunity to digitalize their operations. And the end result of all of this is that chip demand is unusually high, so much so that it caused a shortage somewhere in 2020 and 2021. So facing pressure from governments and also their customers, many of these semiconductor companies, they actually made commitments to expand their capacity. And as a matter of fact, if you look at the chart on the right, you can see that the total industry capex grew by about 30% in 2021 and 2022, and that is significantly higher than the growth rate of about 6% in the years prior to the pandemic. So not surprisingly, this sudden and sharp increase in capex has caused a supply glut. And unfortunately, the timing of this supply glut, it cannot be worse as chip demand is dissipating rapidly, resulting in a down cycle that we are seeing today. So the next question is, why exactly is chip demand falling? So it's no secret that the global economy is on a much weaker footing today compared to the start of 2022. So persistently high inflation coupled with aggressive central bank policy has slowed economic activity substantially, raising the risk of a recession. So the collapse of several US regional banks earlier this year has also added to concerns about the health of the economy. And as a matter of fact, if you look at the latest minutes from the Fed, they indicated that they expect the recent collapses in the US banking sector to trigger a mild recession in the year. So thanks to this greater economic uncertainty, chip demand has fallen drastically. Trapped between high inflation and higher borrowing costs, consumers like you and I, we have been cutting back on spending. And if you look at the data published by IDC, shipments of consumer electronics has actually declined in the first quarter of this year. So with the pandemic boom behind us and a global recession looming, consumer electronics, the demand, it is likely to remain weak for the foreseeable future. And if we look at the latest earnings calls of some of the more prominent chip makers like TSMC and Micron, for instance, they continue to warn of weak near-term demand as the inventory correction continues. However, the good news here is that down cycles, they don't last forever. So despite the current downturn, we are confident that semiconductor sales will eventually recover to higher levels than before, as it has done so every single time in the past. You can see it from this chart over here. And the reason for this is very simple, and it's because the world is becoming increasingly tech-driven. Therefore, we think that it is not a question of whether a recovery will occur, but the question really is when will this recovery take place? And by our estimates, we think that the industry could return to double-digit growth as early as next year. And according to estimates from McKinsey, the semiconductor industry is poised to become a $1 trillion industry by the year 2030, and that represents a compound annual growth rate of around 6 to 8%. And demand for chips, it is set to be driven by structural factors such as the increasing number of semiconductor applications and also the rising silicon content in them. So, for example, these days, the use of semiconductors has become widespread. Recent innovations like ChatGPT and the metaverse, these things are only made possible with advancements in semiconductor technology. So the rising number of smart devices in the world, it is also driving demand for semiconductors. And aside from this, the silicon content in most of the existing applications that we have has also increased significantly over the years. So one example would be cars. So even though cars, they are still largely mechanical since the start of the 21st century, thanks to new innovations like autonomous driving, the silicon content of cars today has increased tremendously. And it's expected to grow even further in the years to come. And according to projections by Intel, semiconductors, they actually make up roughly 20%, will make up roughly 20% of a vehicle's total cost by the year 2030, which is a 5-fold increase from 2019. So the bottom line is this. As the world becomes increasingly tech-driven, the demand for semiconductors will only become stronger than before. And no doubt this will bring immense benefits to the entire industry as a whole. Now, speaking of down cycles in the semiconductor industry, they come about once every few years. But when they do, it is a buying opportunity that is not to be missed. And I understand as investors, it is in our nature to try and find the exact bottom of share prices and to try to pick the exact bottom. But the reality is, it is almost impossible to do so unless in hindsight or unless you're incredibly lucky. So often, investors who are waiting to invest in catch a cycle bottom, they end up missing out on the opportunity altogether. So what we propose is, instead of trying to pinpoint where the exact bottom of the cycle is, what we can realistically do is to identify a range of buying opportunities in the cycle. And in our opinion, the best time to start accumulating semiconductor stocks is during down cycles when manufacturers are cutting back on production and preferably if share prices are at cheaper valuations. So as scary as things might seem during down cycles, we think that down cycles, they are a perfect opportunity for investors to pick up shares at a discount. Now, while there's no guarantee that share prices, it won't go lower in the near term, we are confident that they will be much higher than today in a few years' time. And that is, of course, thanks to the structural growth factors that I mentioned earlier. And if we only focus on current valuations in the industry, it will seem expensive as the industry is currently trading at around a PE of 27 times based on this year's earnings. But if we were to stretch our investment horizon out further by a couple of years, valuations are not as high as they seem today, as they're trading at about 17 times 2025 earnings. Now I know, 17 times, it is not exactly the most attractive number at this point, but we are already starting to see positive earnings revisions in the later years, which also points to a cyclical rebound in the industry. And if this trend were to continue, then valuations will become much more attractive. So overall, I think for an industry with such solid fundamentals, the growth prospects, they are simply immense. And while we understand that conservative investors, you may want to wait for more clarity before deciding whether or not you want to invest in this sector, we think that longer-term investors, you can actually start to build a position using a regular savings plan, and you can then switch to lump sum investments should valuations fall in the future. And to do so, investors can consider our recommended ETF, which is the VanEck Semiconductor ETF. So this ETF seeks to track a basket of 25 US-listed semiconductor companies, and it favors the largest and also the most liquid companies in the sector, such as the likes of NVIDIA, TSMC, ASML. I think if you look at the table on the right, you can see many names that you're familiar with. So one of the reasons we like this ETF a lot is because it has been featured on our focus list since 2018, as it consistently ranks the best among all the semiconductor ETFs in the market out there when put through our ETF selection methodology. So a couple of things that I personally really like about this ETF is its low expense ratio of just 0.35%, which is one of the lowest in the entire industry, and also high liquidity of roughly 7 million shares changing hands each day, so that you can ensure that investors can enter or exit positions without taking too much of a price impact. And lastly, I also think that ETFs, they are a great way for investors to get diversified exposure to sectors, and especially for those who don't have time to monitor multiple stocks, and of course for those who are not confident in your stock picking skills. So ladies and gentlemen, that's all I have for you today, and to conclude my presentation, I would like to remind everyone of the saying that I mentioned at the start, and that is, in a gold rush, you want to be selling shovels. And in this case of the AI rush, you want to be buying chip makers. So thank you all for listening. I wish you all the best in your investment journey, and I'll see you again next time. Bye-bye.